Okay, so today we're going to talk about the most important thing that we can all do with our investments to protect them. Really, to protect our money. It doesn't matter if times are good or bad. It doesn't matter if the market is booming or it's just crashed, because this strategy is timeless, meaning that you can use the strategies in this video regardless of when you're watching this. Now, I am, of course, talking about diversification. So I've been researching this a lot recently, and I want to share my research with you in this video. I'll be sharing real, concrete examples of how to diversify your investments too. You know, with actual specific numbers and specific investment types. I'm not just going to leave you hanging like I've seen with some videos where they discuss diversification as a great concept, but then they never actually go into the specifics of how people like us can genuinely do it. So I want to give you some real, concrete, actionable steps that you can take away from this video. So let's get straight into it. Diversifying is essentially just spreading your money between different kinds of investments. So in other words, you're not just investing solely into the stock market, or solely into real estate, or solely into another investment. Instead, you might pick a mix of these and a few other types of investments. So why would you choose to invest into more than just one investment type? Well, it helps reduce the risk of your overall investments underperforming or losing money. You see, if you're 100% invested into stocks and the stock market crashes, you might lose a lot of money. The same goes with real estate. But if you're invested into, say, both of these, it won't be as bad if one of them crashes because the other one might hold up well. It might even increase in value. This is essentially just the concept of not putting all of your eggs in one basket, which is something I think we're all quite familiar with. But here's a great example of this actually in action. We can see a chart showing 3 different ways of investing. The green bar shows what happens if you hold all of your money in cash. The light blue bar shows a well-diversified portfolio. And finally, the dark blue bar shows what happens if you only hold stocks between the dates of January 2008 to February 2009 during the market crash. Now we can see how these strategies performed. Cash, understandably, remained pretty much stationary. The 100% stock portfolio decreased the most, and the diversified portfolio also dropped in value, but less so than if you'd invested all of your money into stocks. Now, between March 2009 and February 2014, cash remained pretty much stationary again. The all-stock portfolio increased the most, and the diversified portfolio also grew significantly, but by slightly less. You see, diversification means that you might have slightly fewer incredible days, but importantly, you'll also have a lot fewer bad days. When the stock market is crashing and everyone is freaking out, you'll be okay. You'll be holding on to other investments which may have even increased and balanced out some of those losses. And here's the key thing. If you love the stock market and you're thinking to yourself, I want the biggest returns possible, I'm happy to ride out the bad times. Well, this sounds easy in theory, but in reality, when a recession hits, people are faced with their stocks crashing and unemployment tends to rise at the same time. If you lose 50% or more of your portfolio at the same time that you lose your job, it's hard not to cash out some of your stocks. And this is a big mistake. You see, if you'd invested in the stock market from 1997 to 2020 and hadn't sold a single share, you'd have made a very impressive 333% profit. However, if you were forced to sell your shares and you missed just the 10 best days, you'd have made just 123% profit. Think about that for a second. In a 23-year window, if you missed just 10 of the best trading days, you lost nearly 2/3 of the money that you could have made. In fact, if you missed the top 20 days, your return fell to 38%. And if you missed the top 30 days, you actually lost 7% of your money. So while it sounds simple to say, I just won't sell my shares, the truth is you need to make a plan. You need to have a plan so that when the bad times do hit, you aren't forced to sell, or else you risk missing out on the bull run, which usually comes not long after the crash, and you might miss out on some of these top 10 days. So let's get specific. What are the steps that you can take which will allow you to grow your money in the good times and protect it in the bad times? Before we get into that, I'd like to say this video took a pretty long time to research, so if you wouldn't mind taking a moment to hit the like button, I would really appreciate it. Anyway, back to the video. Now, I'm just a regular guy. I actually still live with my family as I'm saving up for the future, so I'm certainly not wealthy, I'm certainly not a financial advisor or anything like that, but I want to share my thoughts on the specific steps that you could take. Step 1 is to save up a rainy day fund. Now, you should have at least 6 months worth of living expenses, which is easily accessible. You need this just in case anything goes wrong. Now, only once you have your rainy day fund in place can you begin to think about investing. But assuming you have this, let's talk about some good investing strategies. The first place to look at is, of course, your own country's stock market. And you should begin to think about being well diversified across this market. As noted in this research, within equities, which is another way of saying stocks, the returns of some companies versus others are not related in any way. Generally speaking, there is little correlation between the performance of, say, biotechnology stocks and utilities, as the market forces driving these two sectors can be completely different. So in other words, the first step is to look at your stock market and then make sure you are well diversified within it. Now, some people will enjoy picking, say, 10 or 20 different companies in the stock market and spreading their money between these. For me personally, I don't have the time or, to be honest with you, the intelligence to pick out the individual winners in the stock market. So I would prefer to buy something like an index fund. An index fund basically tracks the price of the top companies within a country. For example, the S&P 500 tracks the value of the top 500 companies in the USA. So if you're American, it's probably worth having a look into a low-cost S&P 500 index. To find out the name of your country's index, simply search your country name and add stock index to the end. Now, you might be wondering, what percentage of my money should be in stocks? And it's a great question. First, we need to provide some context though, otherwise the answer won't make any sense to you. So we'll come back to it shortly. As noted in this article, there are 4 primary components of a diversified portfolio. Stocks are the first, bonds are the second. So a bond is essentially just another word for a loan. Let's say Amazon, for example, wants to raise money to build more factories. They might go into the market and sell a bond with a 2% interest rate. In other words, what they're doing is they're asking to borrow money and they'll pay whoever will loan it to them 2% interest per year. So when you decide to buy a bond, you're essentially loaning money out to someone in order to receive regular interest payments. You're kind of like the bank in this situation, loaning out money to people. Generally speaking, the more risky the loan is, the higher the interest rate is going to be. So when it comes to bonds, I tend to think safety first. After all, bonds are generally included to make your money safer. So I don't think it makes much sense to buy the bonds of risky companies. If I want to take a risk, it would be through the other investment types that we'll be talking about shortly. As we're talking about diversifying, it probably doesn't make too much sense to loan money to just one company either. If you loan it to that company, or say 2 companies, and 1 or 2 of them collapse, then you've lost a lot of your money. Instead, I want to loan money to hundreds of different companies. That way, a few of them may not pay me back, but as long as most of them do, my money will be safe. So when it comes to specific investment options, you could take a look at something like the Vanguard Long-Term Bond ETF, with a ticker symbol of BLV. As we can see, over 40% of the bonds are US government bonds. So it is a pretty safe bet, as the government are unlikely to default on their loans and the loans to companies are well diversified. You could also check out the Vanguard Total Bond Market ETF with a ticker symbol of BND. As we can see, they have over 60% held in US government bonds, so in theory, it should be even safer. For me personally, I think it's important to have liquidity, which means the ability to quickly buy or sell. So an ETF is great, and the passive investing option is good too. As research has shown time and time again, that actively managed investments, whether that is in the stock market or the bond market, are less profitable than passive ones, and actively managed investments charge you a fee on top as well as making you less money. As with any investment, bonds have risks too. So I'd recommend you look into these risks before investing, as this is an overview video and it would take hours, of course, to cover everything in a high level of detail. Now, the next category are known as short-term investments. The idea here is that you want to keep some money that you can access quickly and easily, but you might as well put it to work in the meantime. So you could consider something like a money market fund. For me personally though, I like the idea of something like a high interest savings account. Well, to be fair, high interest might be a little bit rich in today's market, but in the US you could look into something like Ally Bank, or in the UK you could look into something like Saga Savings. Both offer highly competitive interest rates, and links will be in the description if you'd like to learn more. Next, we have international stocks. Now, this is really an interesting one. You see, the American stock market has historically been one of the best investments around for the last century, and I'm expecting something similar again over the next century. As someone from England, it's a no-brainer really for me to include the American stock market in any portfolio I design, as it really is for anyone else who's also not from America. But the interesting question is, if you are from America, should you include international stocks? Well, according to Vanguard, the leading mutual funds provider, they recommend at least a 20% allocation to non-US stocks. However, I'm going to add that there are also some risks with this. The first is known as currency risk. This risk is associated with fluctuations in a foreign currency relative to the US dollar. For example, a foreign company may report 25% earnings growth, but if its local currency depreciates by 10% relative to the US dollar, the real growth is just 15% when the profits are converted back into US dollars. So when I've mentioned diversifying globally in the past, many of you have actually commented about this currency risk. And I have to say, I really appreciate the feedback, as it highlights what I need to include more clearly in future videos. Hence, I'm talking about it now. So again, thank you. The second risk is known as political risk. This risk is associated with foreign governments and politics. The third risk is interest rate risk. This risk consists of unfavorable changes to monetary policy. For instance, an emerging market economy may decide that it is growing too quickly and act to control inflation by raising interest rates. These dynamics could have a negative impact on the value of financial assets. And another point that many of you have highlighted is that around about half of the money earned by US companies in the US stock market actually comes from international sources, meaning that US stocks themselves are already somewhat diversified internationally. Now, I could provide counter arguments to each of these points. I could say the currency risk isn't so bad in order to get exposure to other stock markets. I could argue that political risk can be minimized by focusing on more developed, politically stable countries. I could make the point that interest rate risk is also okay, as for every country who reduces their stock market value by rising interest rates, you may have another country that reduces their interest rates and stimulates their stock market. So perhaps these are likely to cancel if you're well diversified. And on the point about US companies already being somewhat globally diversified, I could highlight that all US companies are still tied to US regulations and could all simultaneously be affected by occurrences such as, say, changing interest rates that occur solely in the US. But to be honest with you, the truth is that would all be speculation on my behalf, and I don't really trust speculation. I want to see data and proof. Well, according to this paper from Harvard, their findings imply that the benefits of global equity diversification have not declined for long horizon investors, despite the secular increase in global stock correlations. So even as stocks have become more globally interconnected, investing in foreign stocks still provides diversification benefits. Also, the truth is that we simply don't know what will happen in our own countries. While we all have an inbuilt tendency to believe that our country will prosper, the truth is you just never know what's going to happen in the next decade or two. Take Japan, for example. They hit a market peak in 1991, and nearly 30 years later, they still haven't seen those highs again. So if you're from Japan, would it have made sense for you to invest into some international stocks? Well, yes, of course it would have done. How about the UK stock market? In July 2007, it was over 6,200. Today, we're pretty much still at those same levels. So in the last 13 years, investors haven't made a profit. Now, the US stock market, to be fair, has been remarkably consistent, with just a few exceptions, but it hasn't always performed the best. Between April 2003 and July 2007, the Japanese stock market increased by 130%, after its crash in the 12 years beforehand. In the same period, the US stock market performed well, gaining 72%, but still, the Japanese market nearly doubled that number. Now, I could highlight 1,000 more examples. The truth is, we just never know what is going to happen in any country at any time. And that's why holding international stocks as well as your own has been proven time and again to reduce your overall risk. So now we're at that point. Let's talk about some specific numbers. And listen, I could come up with my own numbers to say that you should invest X percentage into stocks and Y percentage into bonds and so on. But the truth is, I'm just researching these things like you. I really don't think I'm in any place to say. So instead, I'm going to turn it over to people who are simply much smarter than myself. Here we can see 4 example portfolios. We have the conservative portfolio with 50% bonds, 30% short-term investments, 14% US stocks, and 6% foreign stocks. Next, we have the balanced portfolio with 40% bonds, 35% US stocks, 15% international stocks, and 10% short-term investments. Then we have the growth portfolio with 49% US stocks, 25% bonds, 21% international stocks, and 5% short-term investments. And finally, we have the growth portfolio with 60% US stocks, 25% international stocks, and 15% bonds. Now, you have to consider your own investment time horizon here. You see, if you're 25 planning for your future, you have many more years than someone who is, say, 60 planning for their upcoming retirement. Generally speaking, a more aggressive approach, in other words, to be more invested heavily into the stock market, will get you a higher return over the years. But you'll have to suffer bigger losses in the bad years. So if you're planning for 30 years from now, maybe a downturn isn't as big a deal for you as it is for someone who is planning 5 years from now. So your time horizon is a key factor. The longer it is, the more you can afford to take on some risk and shift towards the right of the portfolios. The shorter it is, the more you might want to be towards the left. But here's the thing, ask yourself, how well can you mentally handle a downturn? You might have 30 years before you need to sell your shares, but if you can't mentally cope with a big loss on certain years, maybe it's best to play it safe. Have a look at these numbers below and ask yourself honestly what you can handle, because we all have a different risk tolerance. For example, the worst 12-month return in the years for the aggressive portfolio between 1926 and 2015 was over a 60% loss. Ask yourself honestly, can you withstand that and not sell a single share? If you can't, maybe holding more bonds and short-term investments instead of stocks is a good idea for you. Let's look at another option. This all-weather portfolio was devised by one of my investing idols, someone I talk about all the time on this channel, and that is of course Ray Dalio. He recommends investing as much as 55% into bonds, 30% into the US stock market, 7.5% into gold, and 7.5% into a diversified mix of commodities. So interestingly, there is no international stocks or short-term investments, but there is gold and there are other commodities. Well, another example includes property as a key part of their portfolio. Now, this highlights a really interesting point. There is no agreed upon method of diversifying, or one particular mix which is considered the ideal. This can be kind of confusing, to be fair, and I know it would be more simple to be told this is the best path. But the truth is, it's also pretty great because it actually allows us to pick and choose what we like and create our own balance. I personally like the following list of investments: domestic stocks, international stocks, bonds, real estate, gold, commodities, cash, and cryptocurrency. Now, I'll come back to these in a second, but a quick note on real estate. As you know, I'm currently living with my parents as I'm saving up, so I can't exactly go out and buy a house or a flat. I mean, I wish I could, but it's just not realistic for me. Instead, for us smaller investors, we can look into what is known as a real estate investment trust, also known as a REIT. It basically allows you to invest into real estate, but have the ability to buy and sell it like a stock. Hence, you'll find it in the stock market. So let's go back to the favorite investment types and look again at these portfolios from earlier. So you can see concrete values suggested to you in these portfolios. If you want, you could simply take these, copy them, and you do very well. Or you could play around with the numbers. You could also add some other investment types. You could add some Bitcoin, you could add some real estate. If you're feeling more conservative about the market at the moment like I am, then maybe you'd veer more towards the left of the spectrum. If you're feeling more bullish, maybe you drift more towards the right. Ultimately, I can't tell you what to do, as only you know your finances and your own risk tolerance. But hopefully with me sharing these concrete portfolios and the investment types that I like, you now know enough to make an educated decision moving forwards. So recently I put together a few videos looking at what the world's best investors, the world's billionaires, are investing into right now. I think it's a great opportunity to learn from some of the smartest people around. Check it out by clicking up here now, and thank you for watching.